As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you, sir.
Thank you very much. A very good morning, everyone. I hope everyone is doing well. Along with me on this call today, I have Mr. Anmol Jain, the Joint Managing Director, Mr. Raju Keskale, the CEO of the company, Mr. Sanjay Mehta, the Group Chief Financial Officer, Mr. Ravi Tetia, CFO of the company, Mr. Ankit Thakral from Corporate Finance, Mr. Naval Khanna as the Corporate Head Taxation, and Mrs. Priyanka Sharma, Head Corporate Communication. We have loaded our earnings presentation on Stock Exchange and the company's website, and I hope everyone had an opportunity to go through the same. Let me begin with the broad industry updates, followed by operational and financial performance for Q1FY25. The Indian economy concluded FY24 with an impressive GDP growth of approximately 7.5%, surpassing all estimates and positioning itself for further expansion in the coming years. For 3 consecutive years, India's GDP has grown consistently and exceeded expectations, driven by a strong domestic demand, substantial government and private sector capex, and supportive government policies under the Make in India initiative. Signs of a recovering rural economy, robust growth in manufacturing, and stronger exports and services and high-value manufacturing all contribute to the confidence that India's underlying potential will continue to outpace global growth. In the automotive industry, the growing domestic demand from both urban and rural populations, new model launches by the OEMs, the trend towards premiumization, and the steady adoption of EVs have collectively boosted the content per vehicle, driving the overall expansion of the component industry. India's automobile sector has identified multiple critical components for indigenization as part of its localization roadmap to strengthen the Make in India initiative. OEMs are also encouraging the component supply partners to establish local manufacturing facilities, aiming to enhance self-reliance, lower import content, and reduce costs through consistent supply chains. The automotive lighting industry has experienced a significant transformation in recent years, with a growing lighting content per vehicle, an emphasis on both exterior and interior aesthetics, and increasing use of LED lighting, driven by the trend towards vehicle premiumization, longevity of LED lighting, and brightness. Additionally, the market has been propelled by a rising population and heightened concerns about vehicle safety spurred by the government regulations. In line with increasing demand for LED lighting, we have also seen increased order inflows, and 88% of our order book is from LED lighting. We are also working on multiple projects in the company to develop products that meet global standards while considering the local nuances of the market. We have filed 18 patents, with 4 already awarded. By focusing on R&D for innovative and enhanced products, we aim to maintain a competitive edge in securing projects for the new premium vehicle launches by the OEMs. Now, let me share some insights on the Q1FY25 performance. We're pleased to report a 24% year-on-year increase in revenues for the Q1 FY25. EBITDA and PAT grew by 30% and 48% respectively. But this growth in revenue is driven by an increasing share of our LED lighting, which now accounts for 45% of our lighting revenue, up from 35% in Q1 of the previous year. Currently, we have a robust order book of approximately 2,300 crores, with 88% dedicated to LED lighting. Our ability to secure orders from multiple OEMs for new premium models have significantly boosted our LED lighting order book. 43% of our order book is for EV vehicles, and 67% of our order book is for passenger vehicles. In Q1 FY25, we have launched the lighting system for new Jupiter model of TVS, Extreme 160 model for Hero MotoCorp, and the Basalt model of the PSA. Lastly, regarding our capex, we began our operations at a phase 1 Chakan plant in Q3 of last year. Additionally, we have also announced a phase 2 expansion of the Chakan facility, which is scheduled for commissioning in Q1 FY26. This Expansion will significantly enhance our production capacities and capabilities, and also able to meet a broader range of client requirements and support future models in the Maharashtra region. Furthermore, our Saman plant in Gujarat will further strengthen our capacity and ability to provide advanced lighting solutions. Looking ahead of FY25 and beyond, we are confident in our growth strategies and expect to surpass the industry growth through increasing our penetration of LED lighting, expanding our business share with existing customers and engaging in new model launches, and most importantly, enhancing operational efficiencies and productivity to drive higher margins. Now I hand over to Ravi Teotia, CFO of Lumax Industries, for the financial updates.
Good morning, everyone. I'll take you through the operational and financial performance. As mentioned by Mr. Deepak Jain, for Q1 FY25, the share of LED lighting stands at 45% compared to 35% in Q1 FY24, an increase of 1,000 BPS. With 88% of our order book consisting of LED lighting, we are confident of enhancing the share of LED even further during FY25. With respect to segment mix, Q1 FY25 as a percentage of revenue, 65% from passenger vehicle, 29% from two-wheeler, and 6% from commercial vehicles. With respect to product mix, as a percentage of total revenue, 66% of revenue is from front lighting, 23% from rear lighting, and 11% from others. Talking about the financial performance, I am delighted to share that our company has continued its strong performance with quarterly revenue standing at rupees 766 crore, indicating a growth of 24% on a year-on-year basis. The company reported consolidated EBITDA of rupees 70 crore as compared to rupees 54 crore in Q1 FY24, a growth of 29.4%. EBITDA margin for Q1 FY25 stood at 9.1%, a growth of 40 basis points YOY. Other income for Q1 FY25 stood at rupees 12.3 crore. This was up on account of rupees 7.9 crore subsidy received from Gujarat government for our Sanand plant. Profit after tax for Q1 FY25 stood at rupees 34 crore as compared to rupees 23 crore in Q1 FY24, an impressive growth of 48%. PAT margin for Q1 FY25 stood at 4.5% compared to 3.7% in Q1 FY24, an increase of 80 BPS. In Q1 FY25, we have moved to lower tax regime of 25.17%, and effective rate for Q1 FY25 is 26.4%. With this, we can open the floor for Q&A. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Abhishek Jain from Alpha Accurate. Please go ahead.
Thanks for the opportunity, sir. Sir, on the top line, the growth is very impressive, but on the EBITDA margin, there is a pressure and there is a significant decline of around 140 bits.
You're not audible.
Are you able to hear me now? Hello? Hello?
Mr.
Hello?
Abhishek, could
Hello?
you get close to your headset?
Are you able to hear me?
Sorry to interrupt, sir. The management line has been disconnected. Please hold. I shall reconnect them shortly. Ladies and gentlemen, the management line has been reconnected. Over to you, sir.
Hello, sir. So my question was on EBITDA margin. Basically, in this quarter, we have seen a significant decline on the margin because of the higher employee expenses and significant pressure on the gross margin. If you can throw some more color on that, what are the key reasons of the increase in these expenses, and how these expenses will be in the coming quarter?
So thank you, Abhishek. I think there are three things I would like to highlight. Number one, if you look at the normalized EBITDA, taking out all extraordinary one-time incomes, even from Q1 of FY24 until Q1 of FY25, you would see that the EBITDA margins are hovering around close to between 7 to 8.2%. So there is not too much variation on the normalized EBITDA. Of course, if I look at the total EBITDA margin, yes, you're right. There is a variation of, let's say, from a 9% to 10% to a 8%. Now, two fundamental reasons. Number one, you said the expenses are on the higher side. Our major expenses on the fixed costs were increased due to the new Chakan facility, which went online in November 2023. However, unfortunately, the volumes for some of the critical models for which the new investment was made has actually declined since that time period, specifically on the XUV 700. XUV 700 used to be at a 7,000 to 8,000 a month production rate. Now it has fallen down to close to around 4,000, 4,500. So almost, half of what we had anticipated. So, and that's one of the reasons why the fixed costs have increased, but we are not able to see that kind of a revenue offtake from the new facility. Secondly, since the penetration of LED has increased to 45% now compared to, let's say, 39% in the last year, the gross margin or the material margin also is under a bit of a pressure because of high import content still on the LED aspect. So these are fundamentally two reasons why the margins have not grown in line with the top line growth.
So that means that gross margin would continue to be under pressure because of the higher mix of the LED, and the second is the appreciation of the yen in the current quarter?
So we are not necessarily only importing it from Japan, hence the yen appreciation will not really have a significant impact. There are other regions, for example, China is one of the predominant ones where it is more or less on the US dollar aspect. However, there is a very strong focus from the internal team on localization of these electronic components. Let me just clarify that when you're talking about a LED lamp, there are multiple things which are part of the electronics footprint there. One is the LED module itself, which will continue to be imported, and we have no immediate plans of localization. Second is the PCB. The PCB also has two elements. One is the bare PCB board, which up until now was majorly imported, and now we are aggressively going into localizing of the PCB board. The second aspect of the PCB is the SMT, which more or less all of it is now localized since the company made investments into SMT manufacturing facility a couple of years ago. And the last part of the electronic footprint is the connectors, which are still imported, and they are also now going to be localized. So I would say that yes, for probably next couple of quarters, we will still see a similar material margin as today, but once the localization benefits come into play, we will see material margin expansion as well.
So how much capex you will do for the localization of the PCBs in the near term?
Hello?
Hello, sir. How much capex would be required for localization of the PCB?
Sorry to interrupt, sir. The management line has been disconnected. Please wait. I shall reconnect them shortly. and gentlemen, the management line has been reconnected. Over to you, sir.
Sir, my question on the capex side. So, how much capex would be required for localization of the PCB?
So for the localization, we will not be investing. It will be simply a supplier which is an importer to a localized supplier. So we would not necessarily be incurring any capex on account of the localization of these electronic components. This is not our core skill set.
Okay. Thank you, sir. That's all from my side.
Thank you. Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Yes, hi. Good afternoon, sir. So first question on this, the government subsidies. If you can highlight how much of
Sorry
it...
to interrupt, Mr. Kothari. You sound a bit distant. Please come close to the handset.
Yes. Is it any better?
Yes, go ahead, please.
Yes, sorry. So first question on the government subsidies that you're receiving, one for Sanand and one for Maharashtra, the Chakan. If you can highlight what is the quantum and how much should we be receiving every year and for how long?
We got the final eligibility certificate for the Sanand plant, Gujarat plant. So right now that is the only subsidy we have accounted. Maharashtra we have yet to get it. So far Sanand is concerned, the per month subsidy, the per annum subsidy is around 10 crores.
And this is for how long?
It is up to 27-28 financial year. It is for 10 years.
Okay. And Chakan will come once that is approved and done.
And whenever we will get it, we will, do that one.
Correct, sir. Sure. And second, sir, we had Mr. Raju Ketkale come in to kind of head our operations and identify a lot of low-hanging fruits and kind of improve our efficiencies, etc. So if you can just, I think it's been a while now. So if you can highlight what are those few things that we have identified and how are we working on it?
Yeah, this is Raju Ketkale. And let's see, we are now very big way we are taking the activity for improving. One is very clearly now we have some manufacturing efficiency improvement opportunities are available. So very clearly. Then also we have opportunity for the productivity improvement. Okay. We also have opportunity for the capex reduction and utilize all factories which are already invested. So that is also another very big way we are trying to. And then lastly the fixed cost. So this is also one focus area where we are deep dive we are doing in that area, and there is also good opportunity. So with this I think quite good opportunity. We are very clearly, we have a roadmap and we have very clear strategies and we are working on this.
So when should we start seeing this in numbers? I mean, and what is that end goal post?
I think, Mr. Kothari, I think two things. I think number one, we are seeing that in Q1 there is also a strong headwind in terms of the demand. Like I said, we were anticipating an expansion on the margins on account of the new Chakan facility going on stream, but unfortunately one of the key models for which that whole investment went has completely gone south in terms of the volumes. Today my capacity is utilized in Chakan. New facility is just about 60% or 55%. So we do expect in H2, and I would say that Q2 outlook and the forecast is very similar with a lot of headwinds on the demand side. And I think, we will continue to put our efforts on cost cutting and cost optimization internally. But realistically, I would think that somewhere close to the H2, maybe end of Q3 post the festive period or Q4, is when you should start seeing a uptick on the top line as well as the benefits of these cost optimization actions which are undergoing.
Correct. And sir, in your response to first participant, you mentioned that there is some localization which will be done over the next 6-9 months.
Benefit will come next year.
Correct.
So localization will take a longer time, Mr. Kothari. I think in the next, let's say, 6 months, we should be able to have a clear understanding on what all components will get localized where. There is a very long lead time in terms of validating these supplier partners, not just by our partner Stanley, but also by the OEM, because these are critical components for the lighting system. The benefit of that, I would say, it will only accrue sometime in FY26, because these electronic parts also have a very long lead time. So we would exhaust all the imported inventory in the pipeline and only then move to localization. So FY26 is the earliest we could see some benefits of localizing these PCBs and other electronic parts.
Great. Thank you and all the best, sir.
Thank you. The next question is from the line of Rajvi Shah. Go ahead.
Hello. Hello, am I audible?
Yes, you're audible. Please go ahead.
Yeah, thank you for the opportunity. So firstly, I had a follow-up question on the previous participant's question, that what would be our import content as a percentage of total raw materials and any scope to make them indigenously?
So the raw material by itself is mostly indigenized already. When I talk about raw material, I'm talking about the plastic raw material. However, am I audible?
Yeah, you're audible now.
Yeah. So I said the plastic raw material part is more or less all indigenized already. The only imported content still continues in the lighting system for us is primarily the electronics part, which, as I explained earlier, consists of the PCB board, consists of certain connectors, certain capacitors, and of course the LED module by itself. So as of now, this, in terms of the value, I will have to. So about 25% of the total buying value would still be imported, which would again be largely driven by the electronic category.
Okay. I have a few questions on our Chakan plant as well. The first is, you said that you are seeing 60% utilizations currently. So where can we end up this year?
So by Q4, we do expect this to be around 80 to 85%. Primarily, couple of reasons. I think there are certain new programs of Mahindra and Mahindra. The next one being the Thar 5-door, which will get into production, and also by the end of the Q3, Q4, we will be moving our Scorpio production, which is currently in Gujarat, into the new Chakan plant, and hence capacities will also get increased in terms of the utilization levels. But 80 to 85% is what we anticipate by Q4.
Okay. And what kind of numbers have we done this quarter in terms of revenue from this plant?
Yeah. So this quarter, we did the revenue from New Chakan close to 85 to 90 crore, and that's the number.
Okay. And just like one last question. On the phase 2 expansion, remains on track or there are any delays?
So the phase 2 expansion in terms of a timeline continues to be on track, because these are for certain models of OEMs like Volkswagen and Tata Motors, and the model launches have not been delayed. So we need to continue from the timeline perspective. However, as mentioned before, the capex outlook would be re-looked at to prune down the capex, because we will try to optimize our existing capacities before incurring new capex. But the timeline does not change for Chakan 2 expansion.
Okay, that was really helpful. Thank you.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Payal Shah from Billion Securities. Please go ahead.
Thank you so much for the opportunity. I have two questions. First question is on Maruti. So, like, what kind of growth are we looking at from Maruti given their new launches planned for this year?
So Maruti, on a quarter one basis, our year-on-year growth was about 11%, which was pretty much in line with Maruti own production numbers of 7% increase. I think for the full year, we do expect this growth to be a lot better. We had originally anticipated maybe close to a 20% growth. Maybe that growth gets certainly revised to maybe around 15 to 20% in light of certain headwinds in the passenger vehicle segment. But one of the key growth drivers for this year from Maruti would be the new Swift, on which the company is a single source lighting supplier, and the volumes will continue to expand as we go forward in the subsequent quarters.
So just to follow up on my first question, so are we on their EV model which is expected to be launched this year?
So the answer is yes. The first EV model of Maruti Suzuki, we are a single source for that model. However, it is not going to be launched this year. I think you need to get that information correctly. I believe it is only FY26 when that model goes to market.
Okay, that's quite helpful. My second question is, what sort of capex are we looking for the year ahead?
So for the full year, FY25, we are looking at anywhere between 200 to 250 crores capex. A large part of it would be under the new Chakan Phase 2 expansion and also the Sanand, Gujarat readiness for the EV model of Maruti Suzuki.
Okay, and any number on our maintenance capex?
So the maintenance capex would be close to around 80 to 100 crores, which is our usual capex. So about 80 to 100 would be the regular maintenance across all our facilities, across our R&D infrastructure. And these two projects, as I mentioned, would be the remaining part of it.
That's quite helpful. Thank you so much. That's it from my side.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Prachi Sharma from ACE. Please go ahead.
Hi, sir. Good morning. I just have a couple of questions. So I'll just go one by one because I have a few follow-ups as well. So the first question is on the top line front, you have guided a revenue growth of around 20 to 25% in FY25. So does that stand the same?
No, so I think the guidance which I would have is probably more like 15 to 20% on a top line growth. We do expect that in H2, if the volumes come back to the original anticipated, we could be looking at upwards of 20% as well. But my best guidance for the full year right now would be anywhere between 15 to 20%.
Sure. Okay. All right. Okay. So my second question is, like you just mentioned that, you might plan about slowing down some capex. So I just wanted you to give an outlook on the industry. We saw a bit of inventory build-up as well in this quarter. So are you seeing any signs of slowdown?
So as I mentioned before, I think clearly in quarter one, and if you look at the numbers published by SIAM, most of the OEMs in the passenger vehicle space are witnessing higher inventory levels at the retail end, and hence the numbers of production are more or less flattish or single digit. I think most analysts have predicted that their forecast for FY25 for the passenger vehicle space continues to be in low single digits, anywhere between 3 to 5%. So I think we still continue to believe that these numbers are realistic. However, having said that, since our contribution per vehicle will be far more in terms of value. Hence, I'm still hopeful and confident of a 15 to 20% growth as a company for the full year, which is much higher than at least the passenger vehicle segment outlook, which still contributes around 65% of our top line.
Trust. Okay, this was very helpful. Thank you for the detailed answers, sir. I'll get back in the queue in case of any other questions.
Sure.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Shirley Jain from Dolat Capital. Please go ahead.
Thank you, sir, for the opportunity. Sir, mold revenue during this quarter was high. So how are you looking at it for the full year perspective? And how are you looking at it for the full year and upcoming quarters?
So the mold revenue, yes, if you compare this quarter compared to even the previous quarter or year on year, it is much higher. This is completely aligned with some of the model launches. Going forward, I think for the full year, our estimation is anywhere between 220 to 250 crores of revenue from mold revenues for the full year. This is in line with our order book and the timeline for the launches of the new programs.
That was very helpful, sir. Thank you. And how are you looking at M&M being from your full year perspective? How are the orders going to take up space and how are you going to take the revenue guidance to them?
So M&M, I think, continues to be a very strong performer. I think in the first quarter by itself, M&M's overall volumes grew by 15%. However, our wallet share in M&M grew by almost 57%. As I mentioned, we continue to enjoy a strong order book from Mahindra & Mahindra for future launches and are also hopeful for sustenance of the volumes of the current models. So we do expect Mahindra's to be one of the significant growth contributors for the full year, perhaps growing at maybe close to 30% on a year-on-year basis, 30-35% growth coming from Mahindra.
Yes, sir. And one more question.
Sure, go ahead.
Yeah. So your two-wheeler share is currently going up. So how are you seeing this mix going ahead?
I think our two-wheeler share is now almost close to 30%. I think going forward, again, with a higher penetration of LED, so thereby increasing the value per vehicle, the two-wheeler share, I would expect it to be around 1/3 of the total pie. Of course, most of the order book, as I mentioned, the close to 2,400 crore order book which we are sitting at, almost close to 70% is actually passenger car and the commercial vehicle space. So about 30% of that order book is in the two-wheeler space. So I would expect our two-wheeler kitty should be around 1/3 of the total pie, even going forward, perhaps in not just FY25, but even in FY26.
Okay, sir. So what is the current two-wheeler penetration in LED?
The current two-wheeler penetration in LED is about close to 50%.
And that's the same for four-wheeler?
Four-wheeler is slightly more at about close to 55%.
Okay. And thank you, sir. And can you please share the revenue for SL Lumax for this quarter?
So SL Lumax revenue for the quarter is somewhere around 700 crore. I'll just give you the exact number. 794 crore.
Okay. Thank you so much, sir. That's all from my side.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Hi, sir. Just wanted to know your margin expansion plan, we were always that we would be touching double-digit margin, and year-on-year, we will see 100 bits of margin expansion. And last 1.5 years, we were not able to do it for any reason. Can you throw us some light on how we are planning to do it, and when can we achieve that 100 bits margin expansion?
So, Purvaji, I think the margin expansion is a combination of multiple factors, right? Number one, as I mentioned, the reason why we did not see the margin expansion in the Q1 primarily was because of a higher fixed cost, which did not get mitigated by the revenue jump as expected from the new Chakan facility. And hence, we had a big loss on the contribution margin because of the revenue loss. Yeah. Number two, I think going forward, as Mr. Keshale also mentioned, we are trying to significantly optimize our fixed cost and try to balance our capacities as well, so that the investments are reduced and our existing infrastructure is more agile and can handle a lot more from the new order book. I would expect that if the demand comes pretty much back to where we had forecasted it to be in the passenger vehicle space in H2, and I'm quite still optimistic and hopeful that during the festive period, the demand will swing back. I think in H2, we should see us to hit that threshold for the company as a whole. By then, I think a lot of our efforts will start kicking in, and we'll be very well placed to capitalize on the margin expansion the minute the revenue jump comes in.
But even seeing the long-term view, when we are we were in the impression as the LED share goes up, our margin should expand actually on the EBITDA front, not on the contribution margin. But still, when we are hitting from 35 to 45% of LED, still our margins have pretty much declined even on the Q4 basis. If we see the lighting revenue and removing the mold profits, we were very much down. We were at least at 10% on Q4, and we are at 8.25% on Q1. So it was really disappointing to see, even on the higher LED sales and going up, we are still, the margin has declined very much than what we are expected.
So you're absolutely right. If you look at the manufacturing EBITDA, it was at 10.4% in Q4, which has come to 8.4% in Q1. Yeah. And primarily, there are two reasons for this. If you look at the raw material consumption, it's gone up by almost close to 1.6% on a quarter-on-quarter. And this is primarily from two factors. One, as I mentioned, the LED content, when it goes up, the material margin does shrink. The EBITDA margins still expand because of the quantum increase in the revenue will offset some of the fixed costs. And that's the reason EBITDA margin will expand on a LED penetration, but the material margin definitely does not expand, rather it contracts. Second, there are certain price escalations specifically on plastic raw materials, which we have seen in Q1. And obviously, our buying has gone up in terms of the value. We are under discussions with the OEMs to get compensated, but as you know, this is a lag of about 3 months to 6 months. So we do expect in the subsequent quarters, the OEMs to be compensating us from the raw material escalation. So these are the two reasons on the raw material. Second, if you look at the manpower cost, it has gone up from Q4 almost 11.5% to 13.5% in Q1. And one of the prime reasons for that is, of course, not just the annual appraisals, etc., but we had put in a lot of the additional resources in terms of manpower, fixed costs in the new Chakan facility. And, clearly gearing up for the increased volume of the XUV 700, which was anticipated. However, the revenue from Chakan in Q1 has actually reduced by 50% compared to Q4. So it's been a double whammy where the costs have gone up and the revenue has fallen almost by half. So these are fundamentally two reasons why the EBITDA margin, if you look at it from a quarter-on-quarter perspective, sees a dip. However, as I mentioned, we do expect in H2 a strong recovery, given the fact that, and we are not just talking about the XUV 700 volumes coming back. That is one reason, but more importantly, because of the optimizing of the capacities by shifting one model from Gujarat to Chakan, we do expect these fixed costs to be rationalized. And again, as I said, the raw material claims should also kick in by Q2 onwards.
So basically, when the Chakan plant goes into 80-90% kind of capacity utilization, we were expecting somewhat around 17-18% kind of EBITDA. Is it still there or no? That EBITDA margin will not come, and the new norms are being changed.
So you're absolutely right, but the only slight correction: the 17% or EBITDA is at a plant level. Is at Chakan plant by itself. Okay. It does not mean that the overall company's EBITDA will be.
No, I am only talking about the Chakan plant.
Absolutely. It will still be at the same level because nothing has changed fundamentally on the Chakan plant why the EBITDA margin should contract. It is just a dip in revenue and a significant dip. If it's a 10% dip, we can easily manage. We are agile and flexible enough to take care of such dips in the volume and volatility. But if a 50 to 60% dip in volumes happens, then it becomes very difficult for us to absorb all the fixed costs.
Yeah. Okay. And in Q2 also, we are seeing a similar trend which is happening, or no, Q2 is much better than Q1?
No, Q2 is similar as Q1. We are not seeing any strong offtake in demand from the OEMs. Q2 would be pretty similar in line with Q1.
Okay. And what will be the breakup of this 2,300 crore, order book? How will we see that happening? Means when we'll see the real numbers coming in for this?
So I would say that in FY25, we will see almost close to 40 to 50% of this, and most of this will come in H2. Another 40% will be pushed to next year, FY26, and maybe about 10% will come in FY27.
Okay. And any plans where we can tie up with Stanley and export? Any potential export tie-up for that, or outsourcing of Stanley doing from India? Any plans on that side?
So as of now, no. I think as of now, we continue to focus on maintaining our leadership and capturing a bigger pie of the growing Indian market. That's our key focus area, and hence all our resources within Stanley, within Lumax, are clearly focused on increasing our market penetration in India. Exports are right now not a part of our strategy from a product exports. Also, some of our lighting products are not very friendly logistically to be exported. And then again, certain geographic restrictions also are there, when we look at Stanley's own presence in other Southeast Asian markets. So as of now, I would say we are focused on the demand.
Okay. Wish you all the best and thanks.
Thank you, Mr. Mehta. Thank you.
Thank you. The next question is from the line of Rohan Patel from Turtle Capital. Please go ahead.
Yeah, thank you for the opportunity, sir. I just wanted to ask, as of March 24, we have expanded our fixed assets as well as we have somewhat 178 crore as capital work in progress, and we are planning to spend somewhere in range of 250 crores in this financial year. With all this capex plan we are doing, I just wanted a broad idea, what will be our top line, say 3 years out when all this capex are done, if you can provide any guidance, alongside EBITDA that we will be targeting.
Sorry to interrupt, sir. The management line has been disconnected. Please wait. I shall reconnect them shortly.
Sure.
Ladies and gentlemen, the management line has been reconnected. Over to you, sir.
Yeah, sorry, Mr. Patel. I think the management line got disconnected. So I got your question. If I understood it correctly, you're saying that the capex. What is the 3-year outlook in terms of the revenue?
Yeah, in console, like on company level, all the capex that we have done in the last 2 years, as well as we are going to do 250 crore order capex, like 3-year out broad. Yeah.
So I think right now we're sitting on, as I said, the order book of 2,400 crores, out of which almost 17 to 1,800 crores are new orders, not replacement orders, which would need additional capex. And of course, this order book will continue to grow as more and more models come into the Indian market. So I would give a guidance of anywhere between around, let's say, 15% CAGR over the next 3 years. And if I were to, work on that 15% CAGR mark, I would expect revenues maybe around 5,000 odd crores by FY28. I mean, to give you a 3-year perspective.
Okay. And what would be the margins? Like we will be guiding for double-digit margins?
As I said before, I think we definitely continue to hold our guidance in the same thread that we will get into double-digit EBITDA margins. We ideally would have got in H1 this year, but because of the sudden slowdown, we are probably looking at it maybe later part of H2. But I think clearly the guidance remains unchanged in terms of double-digit EBITDA margins.
Yeah, just to add to, I was talking about at FY27 or FY28 when all this capex plays in, we will be looking at double-digit margins. And will that be mid-teen, somewhere around mid-teen?
So it will be difficult, but I would say that yes, anywhere 11 to 13 odd percent should be as a EBITDA achievable, given the next 3 years out, or sustainable.
Okay, that was from my side. Thank you very much.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Yes, hi. Thank you again. So just one clarification. What was the new Chakan facilities revenue number that you shared?
Quarter 1, 85
crores was the revenue from New Chakan in quarter 1.
Correct. And then you did say that it was down by half. So this was in context of what?
The XUV 700 production volume, if you were to look at the SIAM data, where it was in FY24 and where it has come in Q1 of FY25, the production volume is all dropped by almost 40 to 50%. When XUV 700 order was received, XUV 700 was maintaining a 7,000 to 8,000 production volume every month, with clear forecast to go to 10,000 a month, and hence our volumes on a 50% share were pegged at around 5,000 vehicles per month. Now the XUV overall volumes have dropped to close to around 5,000 a month, and our share is about 2,500 a month. So if I do the math, that is a 50% drop, which is what I was trying to explain.
Correct, because but even in quarter 4 of last financial year, we did about 85 odd crores of revenue at the Chakan new facility. So So we're maintaining the same top line, but then why is the fixed cost not being absorbed?
XUV 700 is one of the models. There are other models also which are a part of the Chakan facility. So while you're looking at the overall top line, XUV 700 by itself has reduced by half.
Correct, but the overall sales number is the same, right? So and something else has compensated for that.
So we have shifted some parts of the Scorpio from Gujarat to Chakan to try and offset some of the fixed costs. But that is an internal transfer. So as a company, it gets offsetted. But if you're looking at a Chakan one revenue, it would increase.
Okay. And how much would that be?
Around 15 crore a quarter.
So about 15 to 20 crores would be that Scorpio revenue, which again has moved from one plant to the other. So as a Chakan, if you look, you're not looking at a dip in the total revenue, but that for us is a intercompany, so to speak, move.
Correct. Got it. Sure. Thanks. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. We have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Well, I'd like to thank everyone for joining into this call. We'll keep the investor community posted on a regular basis for updates on the company. I hope you've been able to address all your queries, and please get in touch with SGA for any further information. Thank you very much.
Thank you. On behalf of Lumax Industries Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.